Hi everyone, hope you're doing well. Today I'm doing the UK stocks I'm buying June 2025 edition. So this is where I'm going to go through all my UK stocks that I bought and sold between the 1st of May to the 1st of June. Now I'll do my US stocks in a couple of days time, but these are going to be my UK stocks. There is 7 stocks I believe that I bought and 6 stocks I sold. Well, I sold one of them, the other 5 were trims on the positions, and I'll do them towards the end of the video. Now this is the most popular video series that I do on the YouTube channel because I think people get some stock ideas from it, and as well as that you can track along with the moves that I'm making in the market. So anything I buy or sell are always on this monthly video series. So you can go to back to videos that I did 3, 4, 5, 6, 7 years ago, and you'll be able to see the stocks on those videos and you'll be able to judge them and see if they work out or if they don't work out. I think that's why people like this video so much, because of the transparency. Now, apart from rambling on that much, what I'll do now is I'll get stuck into the video. All I ask you to do is hit the like button and subscribe. Let's get started on to these UK stocks I've been buying. Now, normally at this point, I would say if you do want to know what I'm buying and selling in real time, you could join the Patreon, links in the description. But right now, it is the Discord private sale. So you are able to join the private group and get access to just the Discord, not the Patreon. The reason why I can't do it through the Patreon is because they don't allow more than a 16% sale, and the sale that I am currently giving you is more than 16%. So you could join the private group right now for the summer sale. This is going to run for the next 2 weeks. Last time we did a sale on the private group, there was just shy of about 100 members that joined during that time frame. I think it was like 97 or 98, which was a little bit annoying. It was just short of the 100 mark. But if you do want to take advantage of it, it is running for the next 2 weeks until the 15th of June. If you do want to join, send me an email at jkrinvesting@gmail.com. I'll also leave a pinned comment and in the description if you do want to take advantage of it. Send me an email and then we'll sort it out for you and get you onto the private group. Instead of £72 a year, it is £50 for access to the private group for the full year. This is where you'll be able to get my live buy and sell alerts and over 100 exclusive videos on there. If I was to show you really quickly on the private group, all the exclusive content is on the JKR post tabs. And just right now, I've actually just posted my UK stock portfolio. So you can go watch all the exclusive content like that and talk to a lot of great investors and members on the private group as well. So give that a go if you want to. It's running for the next 2 weeks, guys. And then it is gone. Number 1, Zotefoams. The first stock I bought between the 1st of May to the 1st of June was Zotefoams. I did buy this one earlier on in May. Since then, the stock has run up a good chunk, so I'll just make you aware of that one. But you don't have that many excuses because I have been banging on about this one for a fair bit on the YouTube channel. Now, during that time frame, this stock actually dropped to around about 8 times forward earnings on 2025 numbers and 6 times earnings on 2026 numbers, which is quite surprising because normally this company has traded around about 26 times. So a big discount to what it normally trades at. And by the way, ignore the at loss it's currently saying at the moment. That is actually due to a one-time cash charge, which isn't actually loss making. So just ignore that. But this has been a great company. You know, if you look at the track record of the company, look at the revenue growth, look at the profit growth here. Very good profit growth. Now, what do? They are, as you probably guess in the name, they are a supplier of foams into many industries. The likes of life jackets, swim floats in the sports and leisure, shoes in the transport sector like aircraft, in the likes of cars, in medical products, building and construction. There's a lot of areas that they currently supply their foams in. One of the big ones though that they currently do is their HPP products. This has been the very good growth driver for them last year, growing at 37%. Now, that led them to do very good financials last year, where the revenue was up 16% and operating profit was up 20%. What they do for this product is they do supply Nike, and they have an exclusive agreement to supply the foams that go into Nike shoes. Now, Nike's having a tough time at the moment, but if you actually look at Nike's earnings, the one part of the business that's actually still doing very well is the high-end running shoes. So Nike really do like Zote foams and the foams that they provide, and this has been a very good growing area for them. The other thing is the polythene foams. This has been a little bit of a slower down time at the moment because it was a bit of a slower year with the likes of Boeing having a bit of a weaker time frame, construction slowing down a little bit. But I think that will bounce back going forward as well, and with some of the new factories that they currently have in the US as well. And you see here that the other, outside of Europe, the actual rest of the part of the business was actually doing quite well because UK sales were up 4%, Far East sales were up 18%, and US sales was up 3%. They've also stopped their investment into a part of the business called Mel. This is going to save them around about $5 million a year as well, so that's going to give them a lift in profitability. And in the long term, they are aiming to achieve 200 to 220 million in revenue and operating profit of 36 to 42 million. That's a CAGR of 17% and revenue at a CAGR of 7%. If they are able to achieve that, I think this company will do very well. You're getting a very good balance sheet as well with this business here. If we do look at the balance sheet, around about 31% debt to equity, which is okay. And there's also been a little bit of insider buying. I think Zote foams, for the growth that they're saying they're going to do, with the profit that they potentially could do, around about still 10 or 8 times earnings. Yeah, even though it's gone up a little bit since I last bought it, I still think this is pretty good value for a good company here that has an attractive future. So I am a big fan of Zote foams. Moving on to number 2, Audioboom. I did start buying Audioboom at the start of the month. Same again, this has had a little bit of a rally up since then. Just make you aware of it, but I did start buying it into Audioboom. I originally started buying Audioboom towards the back end of 2024. The stock rallied up massively. Probably should have took a little bit of profit off the table. I didn't, but then the stock gave it all back, and with it giving it all back, I think this drop shouldn't have happened. So I did decide to recently start buying back into the stock, and it has started to rise up a little bit, as you can see here. But I still think this company has a very good future. So what do? They allow podcasters to connect to their audience, so posting on the likes of Spotify, YouTube, for example. And what they do is they get the creators and they link them up with the advertisers to put onto these platforms. And obviously they take their cut from here. You can see here that at the moment, Audioboom believe that they are able to grow at industry CAGR of 22%. Previously, they have grown at around about a 38% CAGR, and they are currently number 3 of the leading independent podcast platforms. That has been a very good increase recently as well. Now, Q1, a little bit weaker on the revenue point of view, only at 1%. But what they said is they did cancel some contracts. They could have had a higher growth if they wanted to, but they cancelled some poor contracts, which would lead to more profitability. And what we're seeing at the moment is, compared to the EBITDA in Q1 2024, it is up 10x from where they were at. So they are starting to see that big growth coming in. And as we know, advertising in Q1 is always the weakest period. Now, what they also have is a new platform. The new platform is something called Showcase. Showcase has 30% gross margins compared to their older platforms, which was 22% and 15% gross margins. Now, Showcase has now gone from 22% of revenue last year to 31% of revenue. I think this will head up towards 50+% of revenue going forward, and that will mean more profit, and we are starting to see that kind of kick in at the moment. And I look at the analyst forecast, and I think the analysts are a little bit weak at the moment. Only 10% revenue growth. We've seen that Audioboom believe they can grow at a 22% CAGR, and if we look at net profit, they think the net profit can only go up around just over 2 million-ish. If you look at the contracts that they're saving, and also some of these big contracts that they had previously that they've cancelled, and we're seeing EBITDA at the moment go up by 10x, I believe this profit is also going to get hiked up through the year. So this means the P, in my opinion, is relatively a bit of a P that's a little bit behind where it should be. People point to the balance sheet being weak on this one. I don't agree. There's no debt on there, and they do sit on around about 3.8 million of cash, and obviously they have turned profitable now as well. Insider buying, there has been a lot of insider buying. In fact, the chairman of the board pretty much buys nearly every 2 weeks at the moment with this company. So yeah, big commitment there to keep doing that. So I do like Audioboom. Number 3, Watches of Switzerland Group. So this has had a pretty good month, to be fair, since I have bought, and it has continued to go up, so just make you aware of that one. But I did add into Watches of Switzerland Group. One of the big reasons why is because they did bring a update out, and they brought the update out on the 15th of May. And when I saw this update come out, the stock actually had a little bit of a dip during that day, and I think it was down like 4% at one point, and I went, it shouldn't have gone down on that update. This update was actually really good. Now, Watches of Switzerland Group, obviously they sell Rolex. You might not be aware, but Rolex is not a public company. So the only really way you can invest into a brand like Rolex is through something like Watches of Switzerland. And obviously Rolex do not sell directly to the consumer. They use suppliers like Watches of Switzerland to sell their products. So really this is only the public way to get into something like a Rolex. Rolex have had a bit of a tough time at the moment because what happened is there was a big surge during 2020 to 2021, and a lot of people were buying Rolexes that maybe wouldn't have bought them. A lot of demand was pulled forward, and what we saw is the natural curve kind of coming back down. Now to me it looks like the prices of Rolex have started to stabilize and will go up, because historically prices of Rolex do tend to go up, so I think we will see a recovery at some point. And it looks from the financial point of view that that's starting to happen. If we do look at the latest trading update from Watches of Switzerland, the H2 performance was very good. Group revenue was up 12%, as you can see here, and especially the US part of the business was very good, growing at 19%. Now this is the part they're expanding massively at the moment. They're opening up loads of new venues into the US, which is great because US have more money to spend on these products, and that is a very good expansion for them as they continue to grow into that space. We have seen Watches of Switzerland have a great track record with their new store openings, and hopefully that will lead to more profit, as we are starting to see. Right now it's 10 times earnings. I was buying this a little bit cheaper, around about 8-9 times forward earnings, but even at 10 times earnings I don't think that's too bad. Historically the company has normally traded a lot higher than this. 33 times earnings, 26 times earnings, 17 times earnings. So yeah, even at the moment, even if we go off the lowest numbers, which is like 17, 15 times earnings, that's a 50% expansion on the metrics from here. And let's not forget, they are currently growing at pretty good rates. And if you look at their long-term guide and you look at what analysts are actually forecasting them to do going forward, it should do pretty well from here. Moving on to number 4, which is actually a stock I bought yesterday. I did buy Hollywood Bowl. I'm buying Hollywood Bowl on this dip that it's currently having. The stock is down around about 10% from that dip yesterday. I personally think that is just way too much. You're currently getting a 4.5% dividend yield with this one, which is really nice to receive that dividend. And historically, this has been a gem of the UK stock. Look at that revenue growth, look at the net profit growth. And right now you're getting it 12 times 2025 numbers or 11 times 2026 numbers. Historically, if we go before the whole COVID situation, this company normally trades around about 18, 17 times earnings, which is probably about fair because this is a high quality UK company. So I think from a metric point of view, this could expand by 50% alone on the PE ratio basis. And then historically, this company has very good growth as well at the moment. You can see here we're expected profit to go from 29 million in 2024 up to 40 million in 2026. Now, the way that a lot of this is happening at the moment and where a lot of this growth is coming from, if we look at H1 revenue up 8.4%, if we look at H1 EBITDA, it was up 8.8%. It's all coming from the Canada expansion. This company historically has been a UK company that is starting to get a little bit more saturated at the moment. There's still a bit of growth there, but not as much as where it was, 5-6 years ago. And what they've done is they've expanded into Canada as they see that as a fragmented market that they can take good market share from. If you look at what they've done since they entered the market in financial year 2022, we've seen the estate growth 3x, we've seen the revenue growth 3.1x, we've seen EBITDA growth 3.4x. This is going to be a major growth driver for them going forward for the next few years. Their target now is to get to 35 Canada centres by 2035. Right now, they're currently sitting at 15 centres. That's where the growth is going to come from for Hollywood Bowl. And I think they'll do it because they've got a good track record of doing it previously as well. You get that lovely dividend. Insider buys as well. We have seen some insider buys starting to come in. We've had the chairman of the board buy some shares as well. We've also seen the CEO buy some shares on the 17th of December, around about 40k worth of shares, which is a really positive to see. They've got an absolute cracking balance sheet. If we look here, there's no debt on there, and they do sit on around about 22 million of cash as well. So that is great, and they can use that into increasing the dividend or doing share buybacks. Big fan of Hollywood Bowl. Number 5 and number 6 I am going to do together because they are very similar companies in the house builder space, which is Barratt Redrow and Taylor Wimpey. I also struggle to do a lot of information on Barratt Redrow because there's still a lot of updating going on at the moment on brokers numbers because of the merger between Barratt and Redrow. But I am buying both of these house builders at the moment. I think these are both high quality house builders. They both pay lovely dividends. It's not showing you Barratt's at the moment on Google. This is a prime example of what I was just saying. Taylor Wimpey, 7.8% dividend at the moment. What we're seeing at the moment is the Bank of England are cutting interest rates. I personally don't think they should be doing it. I've said it before, but they are, and that is starting to set off the demand for the house buying market come back. As well as that, we do have a big shortfall in the UK market at the moment, so there's so much pent-up demand that it should do well going forward. Both of these companies have insider buying going on at the moment, which is a great sign. For example, Barratt Redrow, we've seen the CFO come in and buy some shares last month. If we look at Taylor Wimpey, the CEO also bought some shares around about 50k as well last month. These companies have very good balance sheets. If you do look at the likes of Taylor Wimpey, for example, no debt on there, nice cash balance. Same for Barratt Redrow. So some of these balance sheets are absolutely amazing. They pay you these dividends as well. And when these companies start bouncing back with the house sales, I think they'll do very well. We're starting to see the signs of that at the moment. If you look at the brick maker Forterra, the brick sales are up 22% ahead of last year. So if that's starting to happen now, you have to give it 6 to 9 months, and then they should start coming through in these Barratt numbers, these Taylor Wimpey numbers. And yeah, I'm getting ahead of the curve and see this house building sector start rebounding. And that leads me on to the last stock that I did buy, which was Eurocell. So I did used to own this, sold it out. I've decided to buy back into the company. You get a nice nearly 4% dividend yield on Eurocell right now. Currently on 2025 numbers, 8 times earnings. On 2026 numbers, 6 times earnings. Historically, this company normally trades about 11, 12 times earnings. So if they have the metric expansion, that could be a double up on the metric expansion alone. But they are also looking to achieve good growth in the future. In the last year, this is another building company, so they are in a bit of a slowdown period. But even with the slowdown period, they were cutting costs enough to see revenue go down 2%, but still see adjusted profit before tax go up 32%. They do have long-term ambitions of growing the company by 500 million in sales and 50 million operating profit. So that would be big margin expansion from where they're currently at right now, and also revenue growth, which would be great to see. The way they're looking to achieve that is they have opened up a new racking system. So this gives them the ability to sell a lot more frames from where they're currently at now of 1,100 to 5,200. Obviously, if you've already got the demand or the space there and you are able to sell it a lot more, that's a lot that's going to end up on your bottom line. That's where your margin is going to expand. They've also entered this external living space a lot more. You can see the growth here from where they were last year at 4.4 million up to 8.8 million. They've also done this new build warm rooms. This is a little bit more of a modern version of a conservatory. They started this in 2023, which was 0.1 million. That's now 1 million, and they are targeting sales of 30 million by 2028. Balance sheet wise as well, it's a pretty good balance sheet. If you look here, only 3.3% debt to equity. The only thing that bugged me on the insider front is there's not buying in. In fact, there's been a sell by the CFO. But apart from that, I think the value looks good, and if they do hit the long-term game plan, I think Eurocell could do quite well. And that leads me on to the stocks that I did sell. So there was a couple of trims, and then there was a position I completely sold out of. So the first position I trimmed, I didn't sell it all, I just took some profit off the table, was Gaming Realms. I did a 31% trim and a 20% trim on Gaming Realms. Not that I've lost any confidence with the company. The reason why is I've just been sat on this for a year. The stock hasn't really done anything. And then within the last kind of couple of months, we've started to see the stock wake up. And, you know, I've been in this company for a while, not had anything happen. Now I'm up on the position, a good chunk. And I thought, okay, we're here to make money. I'm going to take a bit of profit off the table. The other little thing that was kind of niggling away is that in the Q1 update, they were at 20% revenue growth, and the forecasts are expecting a big slowdown towards the back end of the year. Is that going to happen? Are analysts wrong, or is there a slowdown? If there's a big slowdown like that, then that completely changed my valuation model. So because of that as well, I just decided to take a little bit of profit off the table, but the main reason was to lock in some profit. The next one I did trim the position on was JD Sports. I locked in a 5% profit and a 10% profit. The reason why is just because I've just been buying so much during this dip. I was buying and buying and buying and buying. I can't believe that JD Sports got down to 63p. But I kept buying the stock. I got a little bit overexposed, but I just knew it was too cheap. And since then, the stock has rebounded. I just knew it was too low. I got a little bit too overexposed, and then the stock rallied up, and I thought, okay, I'm just going to bring this position back into a allocation that I'm happy with and also make a bit of money. So I did take a little bit of profit off the table with JD Sports. The next one was Card Factory. So I did do a little bit of a trim on Card Factory for about 19%. The reason why is because the stock has had a little bit of a bounce up. Also, if you do include dividends on top of this, it's actually a lot higher than that, but I'm just doing it without dividends. The reason why is, same again, I just wanted to make a bit of money on this stock. I've been buying the dips a little bit during these last couple of months, especially when it got into that kind of like 70, 80p range. Just wanted to make some money. And the other thing I'm just going to be careful of is that management said the same thing's going to happen again, where the profit's going to be weighted to the second half of the year. And even though we knew that last year, when the numbers came out, the market absolutely crapped it and sent the stock down massively. So if the same thing's going to happen again, is the market going to do exactly the same thing? I don't know. So I'm just going to lock a bit of profit off the table. I'm here to make money, and that's what I did as well with that one. Next one, B&M, same again as pretty much JD. The stock just went incredibly low, falling down. We actually saw B&M getting to the point where it was like a £2.50 stock. Absolutely ridiculous. The stock has rallied up since then. I kept buying the dip. It got a little bit overexposed, but I just knew it was way too cheap. And now the stock's rallied and I'm in profit. I'm just going to reallocate the position, make a little bit of short-term money. And once again, if you include dividends on top of that, I did take I think it was a 12% profit, but with dividends on top, I'm towards nearly a 20% profit on that, which is obviously really good. Next one, Eslavka. So the stock just continues to rally. So I just took a little bit profit off the table. The valuation is a little bit more stretched. I mean, this is kind of wrong, this P ratio, which realistically probably like towards 16, 17 times earnings. But yeah, the stock just continues to run. I take a bit of profit off the table. I still don't know what I'm going to do with the long-term side of it, but I just wanted to lock in some profit. Being a good performer for us. And a lot of people gave up on this stock. It just didn't do anything for such a long time. People were selling, and then boom, next thing you know, the stock has a fantastic time, ripping up 85% there. And yeah, being a really good performer for us. If you include dividends, this is actually probably the profit I took off this was 70%. If you do include dividends on top, this is probably joining the 100% return club, which is great to see. So absolute great performer for us there. And that's the last stock is S4 Capital. I did just completely sell out of my S4 Capital position. I did take a loss on this one. I haven't taken a loss for a long time, but unfortunately I had to on this one, a 84% loss. So a bit of a whack. A stock I've had for a good 3-4 years now, since 2021, and it's just not worked out. I just kept giving it time, and it's just going in the wrong direction. Maybe I could have been a little bit quicker selling it, to be fair, and got out at 37p, or some other times a year ago could have got out at 49p. Maybe could have been a little bit quicker. I just thought that management kept telling us, like, you know, it's going to get better, and I was like, maybe it is going to get better, or maybe someone's going to buy this company out, but nobody seems to be buying it out. When management keep telling us it's going to get better, every time they tell us that, it just seems to get worse. I mean, I looked, it was the first quarter trading update that just sent me over the edge where I sold it. I can't believe like revenues are still going down 11% when the advertising space is still growing 10% a year. That's absolutely bonkers. I can't believe they're blaming stuff like tariffs now. I don't know why they're blaming tariffs. They're not a company that's going to get affected by that. I hate that. What I also don't like is that they keep blaming like big tech clients that aren't spending, which is true. I look at the sales and marketing of them, they are not spending money. But there's so much work out there. I don't understand why they're not attracting any new clients either. And I don't understand how like EBITDA is still broadly in line with the levels of 2024. Like, if the revenue is going down 11%, surely there's cuts that can be making to be more profitable. Surely they can be using AI and efficiencies to be more profitable. I just don't get how there's no cost control on S4 Capital at the moment. I just had enough. Like, there's just error after error after error, and I just went, you know what, someone might buy it out from here at 300, 400 million market cap. They might eventually get into a little bit of a better position. But what I'm seeing at the moment is that the mistake that I made when I could have maybe sold it a little bit quicker is that I had the mindset of, well, it can't get any worse from here. But it did, and it went lower, and it went from 40p to 28p. And if I went with the same mindset of, like, it can't get any worse from here, but it could, you know, and then we're down at 14p, and I probably wish I sold it. So, yeah, I decided to cash it in, and that's it. So S4 is done out of my portfolio. That's it, guys. I hope you enjoyed the video. As always, have a great weekend. Don't forget, if you do want to join the private group, use the summer sale, £50 for the full year. Send me an email, jkinvesting@gmail.com, and then we'll get you sorted on there. I expect probably another 100 people to use that. So if you do want to take advantage of it, now is your time. Apart from that, Have a great weekend, guys, and I'll probably see you on Monday.